The same thing is happening on COMEX. You're seeing, massive deliveries on COMEX too. We talked about the February. Again, let's look in February. In February here in the United States, when the price got collapsed, you saw 25.5 million ounces delivered on COMEX, but nearly 39 million ounces get loaded out, meaning leaving on trucks 2 million pounds, and it left the COMEX. 2 million pounds on trucks. Who's taking that, and where is it going? When you see the most well-funded and well-informed traders on the globe, from China to the other central banks to our own COMEX, seeing these kinds of deliveries, that nothing else matters. I mean, as crazy as that sounds, you got Wells Fargo sees a potential for gold to move to 8,000 by 2027. UBS, JP Morgan, Chase, Deutsche Bank, and the Bank of America are all targeting 6,000 plus. BlackRock is moving away from their 60-40, as Hartnett had, as has the chief analyst for Morgan Stanley, who said sell half your bonds and put it in gold. This was all orchestrated by margin increases and rebalancing of ETFs. Everything is still in place. You can see it through the deliveries and quietly through the admissions of the banks who don't want to say, well, we told you. On top of all the deliveries, you got the banks saying, yeah, this is where it's going. Now, people wouldn't even notice that because it got collapsed, right? The BIS says this isn't collapse. This was structural. This use misdirection of price, of narrative, of media coverage, of everything. So these things are starting to accelerate when you see removal from the exchanges and really low open interest on COMEX. I read an article yesterday, and I like the way they titled it. They called it the Shanghai Flip. Now, I've talked a lot about this, how in January, when gold and silver both crashed, a flash crash, you could call it, from its all-time high. Let's start with gold first. In Shanghai, it was trading at a premium of between $50 and $80 an ounce. What that tells me is the exact same thing that the Bank of International Settlements came out and said. And in other words, the leverage speculators were facing massive margin calls because they raised margin rates by 300%, they being the CME group. At the same time, it's like the worst time to have done that, because they knew that the first week of January, all of the levered ETFs have to rebalance. And they were way out of whack with the massive rises we had been seeing week over week over week into the end of the year. So you rebalance the ETFs, so you have to sell the stuff to rebalance it. At the same time, they've raised margins. In other words, it was orchestrated is a strong word, but it was structural, not fundamental. The BIS came out and said that. They're like, listen, nothing's changed fundamentally. This was a structural collapse based upon the mechanics on the CME group, the COMEX. So with that in mind, this Shanghai flip, the central banks were continuing to buy hand over fist. But in February and in March, China imported the most silver ever for 2 months in a row. February was the highest month they had ever imported, ever. March beat that. So their silver imports rose by 80% nearly month over month.
It almost doubled in a single month?
Yes, and so that was into March. And silver in February was huge, but March was even bigger. And so it's 173% above the 10-year seasonal average for March. So, and go back and look over the years, you're almost 200% above normal to what they normally buy. Their year-to-date silver imports are up to 1,626 tons, the highest on record. Now, this is when silver was getting its teeth kicked in. Yes, yeah, absolutely.
So the global rush for physical gold, and especially silver, is indeed seeming to go into overdrive.
In gold, too, the third consecutive monthly increase, China, 17 straight months in a row, but their imports rose to 162 tons in March, the highest since March 2024. Third consecutive monthly increase, higher, 17 months in a row of consecutive stockpiling. So yeah, you got the central banks, and in particular China, who used the stupidity of the CME group's margin hikes by 300%. Mm-hmm. To at the same time the ETFs were being rebalanced, to say, great, thank you, we will gladly take that subsidy and stand for delivery. The same thing is happening on COMEX. You're seeing massive deliveries on COMEX too. We talked about the February. Again, let's look in February. In February here in the United States, when the price got collapsed, you saw 25.5 million ounces delivered on COMEX, but nearly 39 million ounces get loaded out, meaning leaving on trucks 2 million pounds, and it left the COMEX. 2 million pounds on trucks. Who's taking that, and where is it going? This is the same thing we've seen every single month. And that is the story that the mainstream has missed, Adam, is that price, all of the things around it are distractions, misdirection. What betrays everything are the deliveries and really the loadouts, meaning it leaves COMEX. And when you take 39 million ounces in 1,000-ounce bars, which each 1,000-ounce bar weighs 60 plus pounds, and you're taking closer to 70, you're taking 39 million ounces and putting it on semis and driving it out of the ecosystem, they'll never come back. They would have to be drilled and assayed to get back in there. That's a sophisticated to the nth degree investor. That is a wealthy to the nth degree investor or investors. And that's someone who knows how to run logistics, take care of insurance, and then unload those trucks where, for what? And, your mind's eye can wander, of course, and you can try and guess. I think a lot of it is the U.S. government, the Exchange Stabilization Fund. Bissett knows gold. It was his largest holding as a hedge fund administrator. It's unusual, and it's very unusual. And so the bottom line is simply this. Everything else be damned. When you see the most well-funded and well-informed traders on the globe, from China to the other central banks to our own COMEX, seeing these kinds of deliveries, that nothing else matter. I mean, as crazy as that sounds, and one other thing, you got Wells Fargo sees a potential for gold to move to 8,000 by 2027. UBS, JP Morgan, Chase, Deutsche Bank, and the Bank of America are all targeting 6,000 plus in the next 12 months. Of course, we talk about Michael Hartnett. We've talked about him before, the chief analyst for Bank of America. I told you he says 25% allocation to metals should be at the expense of selling half of your bonds. He goes on to say, Hartnett says the next phase of the decade will shift from stocks to commodities driven by geopolitical disorder, inflation, and risk. Now you got BlackRock pivoting. BlackRock is moving away from their 60-40, as Hartnett had, as has the chief analyst for Morgan Stanley, who said sell half your bonds, put it in gold. They say the traditional 60-40, we're moving away from it, increasing exposure to commodities, including gold-related assets.
Before we wrap up, let's zoom out for a second, because what we're watching right now is bigger than one headline, one candle on the chart, or one day of price action. This is not just about silver going up 50 cents, or gold pulling back after a strong move. This is about something much larger happening in the global system. We are living through a period where trust is being tested everywhere. Trust in governments, trust in central banks, trust in currencies, trust in debt markets, trust in the headlines, and honestly, trust in the idea that the old financial system can keep running the same playbook forever without consequences. And that is exactly why gold and silver matter. A lot of people still look at precious metals and say, why would I care about silver? Why would I care about gold? They just sit there. They do nothing. They have no yield. That is the old argument. But the world we are moving into is not the same world that argument was built for. Because in a world of rising debt, geopolitical instability, currency debasement, weaponized trade routes, sanctions, proxy conflicts, fragile supply chains, and central banks trapped between inflation and recession, the thing that just sits there starts to look very powerful. Gold does not need permission. Silver does not need a bailout. Neither one needs a central banker to reassure you on television. And that is why every serious conversation about the future of money eventually comes back to hard assets. Now think about where we are today. Global tensions are not fading away. They are multiplying. The Middle East remains a pressure point. Europe is still dealing with long-term strategic instability. Asia is becoming more economically and militarily competitive. Energy corridors matter. Shipping lanes matter. Semiconductor supply chains matter. Food security matters. The dollar system matters. And every time one of these things gets shaken, markets start repricing risk. That repricing of risk is where gold usually gets the first spot. Gold is the monetary metal. Gold is the one central banks understand. Gold is the one they quietly respect, even when they publicly act like fiat is invincible. But silver is different. Silver is the metal that lives in two worlds at once. It is monetary, but it is also industrial. It is history and future at the same time. It is old money and modern technology in the same metal. That is what makes silver so interesting, and frankly, so explosive when momentum finally builds. Because silver is not just a shiny rock. It is used in electronics, solar infrastructure, industrial systems, advanced manufacturing, medical applications, and more. So when the world talks about green energy, electrification, reindustrialization, military tech, grid expansion, AI hardware, and supply chain security, silver is sitting right in the middle of all of it. That is why silver bulls never really go away. They may get mocked, they may get early timing wrong, they may have to sit through painful consolidation, but the core thesis keeps coming back because the metal keeps mattering. And let's be honest, silver has a personality that gold does not. Gold moves like a king. Silver moves like it just drank 3 espressos and saw a breaking news alert. Silver is calm until it isn't. That is why silver drives people crazy. It can look asleep for weeks, and then suddenly it moves like the market remembered all at once that above ground supplies are tight. Demand is real, and the paper game only works until confidence starts slipping. That is the part many casual viewers miss. Most people only become interested in silver after it already made the move, after the breakout, after the headlines, after the FOMO starts, after the mainstream financial channels begin pretending they always understood the story. But real positioning usually happens when nobody is excited, when the comments are quiet, when the chart looks boring, when everyone is distracted by the next hot trade. That is how these markets work. And the geopolitical side only makes this more important. Every new conflict, every new sanction regime, every new currency settlement outside the dollar system, every new shipping disruption, every new defense escalation, every new energy shock adds stress to the financial architecture. Maybe not enough to break it in one day, but enough to weaken confidence over time. And markets run on confidence. That is the key point. The system does not need to collapse tomorrow for metals to matter. It only needs people to slowly realize that the system is not as stable, not as neutral, and not as durable as they were told. That is when gold becomes a signal. That is when silver becomes a story. And that is when retail investors, institutions, central banks, and everyday savers all start looking at the same assets from different angles. Some buy gold because they want security. Some buy silver because they want leverage to the same macro trend. Some buy both because they do not want all their faith sitting inside digits on a screen backed by policy promises and political incentives. And can you really blame them? Look around. Governments keep spending, debt keeps rising, currencies keep getting diluted, wars keep threatening trade, politicians keep promising stability, and ordinary people keep noticing that their money buys less than it used to. That is not conspiracy. That is lived reality. This is why gold and silver are not just investments to many people. They are a response, a hedge, a form of skepticism, a statement that says, I do not fully trust the system, and I want something outside of it. Now, does that mean metals only go up? No. Does that mean silver cannot be volatile? Of course it can. Does that mean gold cannot correct? Absolutely not. But zoomed out, the bigger picture is what matters. Precious metals do not need perfect conditions. They need persistent stress, and the modern world is delivering plenty of that. That is why, on this channel, we do not just stare at price charts in isolation. We connect the dots, because silver is not trading in a vacuum. Gold is not moving in a vacuum. Markets are reacting to debt, diplomacy, war risk, central bank behavior, inflation expectations, real yields, industrial demand, and public psychology all at once. That is why one random headline can move these markets. That is why one central bank statement can change momentum. That is why one geopolitical flare-up can turn boring metals into the most interesting corner of the market overnight. And this is where the memes almost write themselves. One day the mainstream says, nobody needs gold anymore. Next week, central banks are stacking it. One day people laugh at silver holders. Next week, they are posting rocket emojis after a $2 move. One day, analysts say inflation is under control. Next week, your grocery bill files an official complaint. That is the clown world element of markets. You can almost picture the meme. Fiat currency after another trillion in debt spending. I'm tired, boss. Or this one. Silver investors after waiting for months and seeing a 4% move. Everybody stay calm. Everybody stay calm. Or the classic energy of the metals crowd. They called me crazy at 22 silver. They called me lucky at 32 silver. They called me again at 40 asking what to buy. That is the emotional cycle in a nutshell. And if you want a few tweet-style lines to flash on screen during this segment, here are some that fit perfectly. Gold is not chasing the news. It is pricing the loss of trust. Silver is what happens when monetary anxiety meets industrial reality. Every empire prints. Every market pretends. Gold remembers. Paper promises are infinite. Real metal is not. Geopolitics is bullish for uncertainty. Uncertainty is bullish for hard assets. Central banks buy gold while telling you everything is fine. That should tell you enough. Silver does not move when people are comfortable. It moves when comfort breaks.